let's get to those top picks. Number one, Savaria, which makes mobility equipment, stuff to help people get around in their house.
Right, so they're a global leader in home accessibility equipment and patient handling products. They manufacture home stair lifts, home elevators, mattresses, ceiling lifts for long-term care facilities. And they're now the largest player in the world after they acquired Handicare a couple of years ago. This year their results have shown very strong organic sales growth in both home accessibility and patient handling. They have a near record backlog as well, and have shown improving margins. The stock got hit when they released their second quarter results because there was a one-time hit to EBITDA from the implementation of a new ERP system in Europe, which affected their results there, which we consider a one-time event. And the company recently issued some equity in the last few weeks, which caught the market by surprise. So that always tends to depress a stock when you see an equity issue. But I think they're being prudent. They're paying down debt with it. And it probably indicates that there's some interesting acquisitions out there for them to pursue. So, we've owned this stock since it was $5. We really like management. We really like the space. We think this is a great buying opportunity. We actually bought more shares in the last week or so. It's trading near its historic lows of 9 times EBITDA, and this is a company that's, a growing business that's benefiting from, huge demographic tailwinds from the aging population and the desire to live at home longer. So, great time to get into this company if you haven't owned this stock already.
MDF Commerce, involved in what aspect of the internet?
Right, so this is we consider this a grossly undervalued tech stock. They develop and manage business to government platforms, which allow suppliers to bid on government contracts, which is called e-procurement. And they also have some e-commerce platforms for corporations like Sobeys and Aldi. So MDF is a leader in e-procurement in Canada, and they're now the #1 player in the US. Having acquired a company called Periscope a few years ago. And it's early days in the US for states and local governments to digitize their procurement process. And they've recently announced some very significant contract wins in Arizona, Arkansas, and Hawaii. I mean, they have a record pipeline of regional and state governments currently. 80% of their revenues are high margin recurring revenues. The company's profitable now, generating positive EBITDA and positive cash flow. If you look at some comparable e-procurement companies that were acquired in the last few years, the stock should be worth up to $12 a share. So we see good growth in results, good growth in profitability over the next few years, and possibly eventually an acquirer will come and buy the company. So great turnaround story happening here. And they're really one of only 2 players in the US that are picking up all these state and government contracts right now.
And then finally, VLAN, a maker of high-quality valves for the nuclear industry. You, for a long time, followed this stock, and then there was a buyout. You thought the price wasn't great. And then the deal apparently hit a glitch last month. Talk to us about VLAN.
Right. So we mentioned this company in the past. The last time we recommended it was, I think, $5 or $6 at the end of 2022. And earlier this year, they accepted an offer of $13 a share from a U.S. company called Flowserve. And the stock was trading near $13 for most of the summer. We sold our shares at $12.75. But then when we saw the stock price collapse down to even below $10, on worries that the French government were going to block the sale because their nuclear valve division is based in France. We had a quick look, and we concluded that the fear was overblown, and we don't see any difference between a U.S. company controlling the French division or a Canadian company. We think that the deal's still going to get done. We think the French government should approve the transaction hopefully in the next few months. VLAN and Flowserve have extended the deal deadline. So we think there's an easy 30% return to be made here, and we've reestablished our position around the $10 level, expecting the deal to close between now and year end at $13. So, I'd call this a short-term event-driven investment that has very high odds of taking place.
Yeah, so you feel that this shouldn't be a terminal hit to the deal, this French objection?
No, I can't see what they're objecting to and how they could block a transaction. I mean, they could put some conditions like keep the technology in France or the jobs in France, those kind of things. There's always a way to work around these things. I think the French government has a lot of posturing, and then, of course, they're all on holidays in August, so nothing gets done. So I would expect, the French government to approve this transaction, because that's really the only approval that's that both companies are waiting for. They have all the other approvals that they need to close the deal.
We better leave it there, Stephen. Thank you very much indeed for joining us. Brian's first idea is an ETF that's bullish on the US dollar, UUP.
Yes. So again, I know we've talked about this a couple of times, and again, a lot of acro-friendly investors, we have a lot of US dollars. It helped us out last year. We had a big move in the dollar in terms of rates of return. So again, I would diversify out of Canada. I would certainly have a good slug of certainly my portfolio in US dollars, and just buy and hold and see what happens.
Your next idea is the TLT, which is a US ETF that tracks the bonds. I mean, that one's been suffering with the rise in interest rates.
Yep, I've recommended it a few times here. I am down. Now, again, I put these provisos in. One is I'm not leveraged. I'm actually getting a pretty nice coupon every month. And it's coming in US dollars, which makes me happy. But again, the secret in this whole strategy is on a yearly basis, you rebalance. So come December, I'm going to sell, obviously a portion of my gold. I'm down in my ETFs. So I'm going to buy, more TLT. To keep it even.
I know, it goes against your instincts, I suppose.
Well, again, it's a simple strategy. Yeah. If you have, markets are markets, but it's amazing. If you have a logic, or if you have a system like dogs of the Dow, et cetera, and you keep on rebalancing, it's amazing how much money you make on the rebalancing. So it's a little secret sauce. But again, in December, I will be selling some of my gold and putting there, again, all in US dollars.
Right, so you're all about US dollars.
All about US dollars, assets that will perform if something happens.
Right, so if bond yields come down, that'll push up your ETF.
Yes.
And it's similar for your final call, which is a Sprott, the Sprott Physical Gold Trust. Yeah,
right.
Not paper gold. Sprott
paper.
likes to emphasize that.
You don't want Barrick. You don't want any of these. Look at the AEM,
Agnico Eagle.
Yeah. It's like, it's a perennial underperformer. I don't know what it is. They're like, can they get that stuff out of the ground or not? So again, don't play with that. Play with the physical. It sits on a shelf. And again, how can we have a move on the TLT without a composite move in gold? So, you're kind of sitting there going, well, if inflation's as big as what the TLT is saying, why isn't gold going up? So again, it's a strategy where it's a pair. And so what's happening with the price of gold? What we're having here in the last since July is like a little inflation scare. And gold is, kind of doing nothing. It's kind of hanging in there at 1950, right under the highs. Right. But again, it should be higher relative to the TLT. That's all I'm kind of saying.
And why in particular gold, though? Because you see deflation in America, but inflation around the world.
So what should happen going forward? Investors, you have to game this. Things are going to happen pretty quickly once things start to unravel. But again, there's a scarcity of US dollars. Rumor has it yesterday, China was actually selling oil to get US dollars. Okay? So there's a dearth of US dollars. that should basically, get the U.S. dollar. And again, I'm arguing it's going to go considerably higher here. It's almost like a short squeeze. But again, the rest of the world will have to inflate to paper over, if you will, the deficits and the balance of payments of each particular country. But the U.S., as it deflates, okay, then it will turn around and hyperinflate. That's where gold comes in. I'm not smart enough to pick which asset is going to perform which way. That's why you want two of them. And it's a long vol. So again, we see the VIX moving up to 19, 18 and a half today. It hasn't been there for a good time. But again, you want assets not correlated to the VIX. Okay, so those two assets, both the long bond and gold, are basically low vol strategy going into a high vol world.
Okay.
And that gives you a lever of protection as well.
Brian, thank you very much indeed. You gave us loads of food for thought there. First idea here is Dream Industrial REIT, DIR.UM.
Yeah, so Dream's our largest holding in the industrial warehouse space. The REIT focuses on Canada and Europe, about 2/3 of the portfolio in Canada, with a major focus on Toronto and Montreal. The Toronto Montreal industrial markets are seeing market rent growth of 40 to 50%. The REIT's enjoying over 60% renewal spread increases, meaning when leases come up for renewal, they're able to increase to quite elevated amounts. Strong internal cash flow growth at a time where the REIT's trading at quite a large discount to its net asset value of $17, $18. So we're very excited to own this type of quality real estate trading at a wide discount to net asset value while cash flow continues to grow.
Let's get to the next one. Sun Communities. What do they do, Andrew?
Sun Communities, listed in the United States, focuses on the manufactured housing community and RV and marinas sector. About 80% of its portfolio is focused on manufactured housing and RVs. MHC sector, think trailer parks, is a very, very recession resilient sector. This sector has never had a year of negative net operating income growth. Think affordable housing in the United States. Very rarely does this sector trade at a discount to net asset value given these high quality cash flow attributes. It does have an investment in the United Kingdom, about only 5% of its asset base. That sector has given it a bit of a pause in terms of the ability to do home sales and put a bit of a pall on the stock. We think it's been overly punitive in terms of what the stock market has done. And here's the ability to buy a blue chip company trading at a discount to net asset value. And we think values over $150 make a lot more sense for this stock. So this is a buy for us.
Okay. And let's head out to Western Canada here. Boardwalk REIT, apartment giant, but they have a lot of assets in Alberta.
Correct. And Alberta benefits from population growth, both international immigration, interprovincial migration, foreign students. And the good thing about Alberta and Saskatchewan is that they are not rent regulated, meaning there is an ability to increase rents to market levels if warranted. And I think Boardwalk does a great job of providing quality housing to both residents and new Canadians. And you have the ability to own this company at quite a large discount to net asset value, called 20% relative to its own published NAV. So we continue to own Boardwalk. It's been a large holding for us for many years, and we think the outlook continues to be bright for that stock.
And broadly, when you're buying an apartment REIT, what are you looking for? I mean, you're looking for the ability to raise rents, I suppose.
Well, any real estate, we're looking at supply and demand. So, so long as demand is greater than supply, that's the starting point. And in this case, for sure it is. New construction is at a low, and demand is certainly outpacing any new construction. And then there's the ability to, yes, increase cash flow over time, or keep margins constant or even increase margins. I think that's important, especially in a period of elevated interest costs.
Right. What do you, I mean, the massive rents in many parts of Canada are a political hot potato. Is there likely to be some kind of backlash against the apartment REITs?
No, what we found time and time again is that the apartment REITs provide quality housing at a fair rental level. The solution is never rent controls. The solution is always new supply. It's just supply and demand in any sector. This is just widgets. I think the REITs do a great job, particularly Boardwalk, in terms of self-governing rent renewals. They could increase rents, or for argument's sake, 20%, but they seldom go above 9%. I think that's a very important characteristic. They want to be good landlords, and they don't simply just meet the market in terms of what the market can bear.
Andrew, great talking to you, and thank you very much indeed. Let's get to those top picks. And before we get into it, I just want to clarify, Eric Nuttall is disagreeing with this TD report in which TD says we're bringing down our energy stock weighting to market weight, TD raising the risk of oil demand destruction with this huge run-up. Anyway, Brian's first idea here, Hershey chocolate.
That's right, Andrew. The days are getting shorter, and as they say, winter is coming. But first, Halloween is coming. Halloween, of course, being one of the four core seasonal selling seasons for Hershey, the others being Christmas, Valentine's Day, and what they call s'mores season, which is summertime. Those marshmallow graham crackers.
Yeah.
Hershey, of course, is the largest chocolate producer in North America with a very dominant share, 45% in chocolate, narrowly, and 30+ in confectionery more broadly. Viewers will all know and likely relish their well-known brands like Kisses, Reese's, Twizzlers, Kit Kat, Brookside, Almond Joy. So that's what it's best known for. That's about 80% of their business. They have a small but fast-growing salty snacks business with brands like Skinny Pop and Dots Pretzels. And then they have a small business selling both sets of goods into developed and emerging markets. We like the company because it earns best-in-class operating margins, about 10 points above its peers. And it leads all of its peers in profitability with a 26% return on its invested capital. That's about 3 times its cost of capital. So clearly the brand is very strong here, and they monetize it quite effectively. It's also the best consumer packaged goods company in terms of its ESG, environmental, social, and governance rating. Viewers may not know, but the controlling interest is owned by the Milton Hershey Trust, which funds schools for underprivileged children. The company is also doing a lot of things, investing in renewable energy, which is good for the planet, and has the ancillary benefit of lowering their effective tax rate to the mid-teens from a more normal U.S. rate of 22 to 24%. The shares have pulled back about 27, 28% off the peak in May. And that's on the back of concerns about elasticity in the chocolate and candy category overall. So price increases have been taken that have been drastic. Volumes are declining. We think we'll get to the point where we lap those price increases and the volumes start to stabilize because everybody loves chocolate. And the shares right now are trading at 20 times earnings, nicely discounted versus their long-term average at 24. So new entry and a good buy for us, we think, here.
I might have misheard you. I think you might have said Kit Kat, but that's a Nestle brand.
Hershey has the rights to it in North America.
Oh, they do? I'm so sorry. Okay, yeah, but I knew it was globally, it's Nestle. I didn't know Hershey had it in North America. Linde, PLC, not Lindt, not more chocolate, Linde, the industrial gas company.
Yeah, it's easy to mistake them. But this is the largest industrial gas company in the world. So they sell hydrogen, oxygen, nitrogen, carbon dioxide to a variety of end markets: manufacturing, chemicals, energy, healthcare, metals, electronics, food and beverages. The predecessor company to this was Praxair, and then it merged with Linde in 2018, which actually reunited two companies that were historically attached. But what we like about this company is that it's got a good mix of end market exposure, some in defensive verticals, others in growth sectors. They primarily strike long-term take-or-pay contracts with their customers with commodity cost pass-throughs, and that allows them to earn a high and stable return on shareholders' equity. And it's been 3+ decades of annual dividend growth cadence, so it's quite rightly earned a spot in our dividend growers portfolio.
And finally, Bank of Montreal. It has been something of a relative underperformer versus TD and Royal Bank, certainly last time I looked.
Yeah, year to date, I would have to look, but
Sure.
you know, over the cycle, it keeps pace with both of those fairly well.
Okay.
It is the third largest bank in Canada. It's now
The largest.
third largest bank
Third
in
largest.
Canada.
Yep.
Yeah, and post the merger of Bank of the West, which they closed earlier this year, it's one of the top 10 banks in the United States. It's now operating in 32 states, so nice scale and breadth of coverage there. Mm-hmm. Their strong suit really on both sides of the border is in commercial banking and lending. Okay. They over-index that segment versus personal compared to the other banks. It's rounded out by a large Canadian wealth management business and a good-sized North American capital markets business, and then a smaller insurance business. The Bank of the West deal is expected to bring in $670 million of synergies as soon as mid-year next year. And then also through real estate and headcount rationalization, they've targeted another $1 billion in cost savings. So right now you've got a bank with a 13% return on its shareholders' equity and a 7% growth rate in dividends over the last decade, yielding 5.2%. So add them up, double-digit return in our view over the coming cycle. So good entry point here with the pullback.
Okay, total 5-year return according to Bloomberg, 33%. Including dividends, and actually marginally ahead of the banks index, which was about 29% over 5 years. Thanks very much indeed. That was Brian Madden.
Welcome back. It's time now for top picks. Eric Nuttall's top pick on this day is Cenovus Energy, ticker symbol CVE in Toronto. Eric?
We remain bullish on oil. We think oil is going to trade at roughly an $85 to $105 band for the next year. So using a $90 a barrel per day context, we're looking for leverage. Cenovus provides meaningful leverage to a $90 oil price. We have them reaching their final debt target in January, at which point they're going to pivot to returning 100% of their free cash flow back to investors. At the current oil price, we would have the name trading at a 17% free cash flow yield. We would expect the company to buy back 17% of their shares outstanding next year. And so our thesis is that meaningful buybacks on behalf of Cenovus and the sector at large next year will finally drive a re-rating. We think this name should trade at a 6x multiple, which is near a 10% free cash flow yield. That's about 50% upside at the current oil price.
Okay, let's go to number 2, Athabasca Oil. I think this is a very top holding in your fund. Am I right?
It is. We own 9.9% of the company. It offers you the highest leverage to a narrowing differential for Canadian heavy oil. They have 40 years of proved reserves, and we're paying 3 times cash flow for that. The name's trading at a 20% free cash flow yield at $90 oil. They're currently giving us 75% of that back. They're actively buying every day. And so again, that meaningful buyback of 15% of their shares outstanding next year at 90, it'd be approaching 17, 18% at $100 oil. We think drives a re-rating in the name closer to a 5 multiple, which at $90 oil would be about $6.50, which is about 60% upside. And when we think about this is a great example of the risk in this sector where balance sheets have been so massively healed from the COVID lows. This name went from one of the most over-leveraged names that was staring into the abyss in 2020. They now have net cash on the balance sheet. They're debt-free.
Interesting. And we'll see more of that, you believe, from names in the sector, debt-free balance sheets.
Or the ability to become debt-free should they so choose.
Okay. Number 3, the final top pick today, Crescent Point Energy, ticker symbol CPG on the TSX.
So Crescent Point has successfully transitioned from a short reserve life company of conventional production in Saskatchewan to now more inventory depth in the Duvernay and the Montney. They just recently drilled a boomer of a well. It's almost 2,000 barrels per day, 81% of which is oil. They've got offsets to that. And so it speaks to the step change in productivity and the step change in capital efficiencies. That all means that they're generating more and more free cash flow. They're returning 60% of that free cash flow back to investors. And so we have the name trading at $90 oil next year, a 28% free cash flow yield. We would expect to get 60% of that next year. And so for a name now with 15 years of high-quality inventory where they're going to modestly grow but really return a meaningful amount of that free cash flow, we think the stock is completely mispriced at 2.5 times. We think if this name trades to 5 times, you've got potential upside over 100% over the next year to 2 years.
Dividend yields about 3.5%. It has raised its dividend fairly recently from 8 to 10 cents per share per quarter, correct? And has also issued special dividends along the way, correct?
Correct. So at base dividends, I would expect the Crescent Points, the Headwaters, the large guys, it's going to be a once-a-year phenomenon, usually year-end once they set their 2024 or annual budgets going forward. But this is going to be a low to no growth, high free cash flow, really attractive payout sector where we've got the sector trading at 17% free cash flow yield next year at the current oil price, where we've got C&Q reaching their final debt target, I think, next month, Cenovus in January, MEG in March, and one after another, as they pivot to 100% of free cash flow, seeing will become believing. When people see the amount of buybacks that the companies are walking their talk, we remain very optimistic on the remainder of this year in 2024.
Eric, it's been great to have you, and I know our viewers feel the same way. Thanks a lot.
My pleasure. Have a great weekend.
That is Eric Nuttall. He was our guest today on Market Call.